Hello, everyone, and welcome at the Unlocking Value in Digital Assets for Institutions CVA virtual session. My name is Emi Lorincz, and I have the honor to be the president of the Crypto Value Association, as well as working for Talos in my that's my full-time role. And today we are diving into staking, lending not so much actually, AMMs, and also how institutions can benefit of all these products and services. And we have today with us Eva from Figment. We have Justin from Bullish, Kasper from Crypto Finance AG, as well as Mark Richardson from Bancor. I will invite all of you to introduce yourself and say a few sentences about your company, and I encourage also the audience to post questions in the chat. We are trying to make it as interactive as possible. So Eva, would you be so kind to intro yourself and kick this off?
Yeah, sure. Thank you, Emi, and thank you for having us all. Hi, everyone. My name is Eva Lorincz. I am the head of EMEA for Figment. We are the complete staking provider for institutions. We help platforms and asset owners launch staking strategies. I've been in crypto for around 5 years now. Prior to that, I was in the traditional finance space as an equities finance trader and headed up European flow trading for Morgan Stanley's security lending desk.
Thanks so much, Eva. Justin, you want to go next?
Oh, yeah, sure. Justin Short, I'm head of trading product at Bullish. I've been in crypto for about 10 years, and prior to that was traditional finance investment banking for 15 years. Bullish is a regulated, centralized exchange designed for institutional access to crypto. We're regulated out of Gibraltar. We have a unique liquidity model, perhaps we'll cover that later, which combines a centralized order book and an AMM. We've been live for 1.5 years and growing pretty fast. We've just about hit $200 billion of traded volume.
Thanks for packing in some stats there. I asked all of you to bring a lot of data and stats today. Thanks so much. Then on to Mark from Carbon, Bancor.
Thank you, Emi. Yeah, my name is Mark Richardson.
Yeah, sorry I just wanted to say that you're the lucky one, Mark, here, because you're in hopefully sunny Australia. Thanks so much for tuning in now. I'm sitting in gloomy, rainy Zurich. So
it's always gloomy and rainy in Melbourne, unfortunately. But yeah, my name is Mark Richardson. In a previous life, I was an organic synthetic chemist. I joined the Bancor protocol as a full-time researcher in 2021. Soon thereafter, I was the head of research, and I've since taken over leadership of the project as of October of last year. Bancor has had a very long history. In an institutional sense, I think that we used to serve predominantly the liquidity needs of new projects, and this is something that we used to collaborate with institutions on. But with our most recent product offering, which is Carbon, we are catering much more to active trading arms, and certainly we're speaking with institutions about how they can leverage their liquid token funds and similar to achieve financial goals in DeFi.
Thank you so much. Kasper, would you like to go next, please?
Sure, thank you, Emi. Also here in gloomy Zurich, but quite high in the Prime Tower in our headquarters here at Crypto Finance. I'm the head of product at Crypto Finance, so I look at the development of all our new products and services. Crypto Finance is a regulated asset manager, broker, and a custodian. We have offices both in Switzerland and also in Germany. Because we are part of the Deutsche Börse group. We got acquired back in 2021. So we're also now building services for the European market out of Germany together with Deutsche Börse. We are serving regulated financial institutions. And recently we've also launched a tokenization as a service offering to also start looking beyond cryptocurrencies.
Thanks so much. Super living the high life high in the Prime Tower. Nice. Kasper, I will actually direct the first question to you. When we prepped, you were saying that it's really important to shed light and a bit give a refresher on what staking is, because maybe not everyone in the audience is aware. So why don't you go ahead and explain staking, please, and why is it big innovation of Web3? And then we can talk about staking strategies for institutions.
Sure, I'll kick it off, and if I miss something, Eva can bring me back on track. So yes, staking is a new phenomenon. It's a concept which is native to blockchain, and it's actually quite interesting because it enables shareholders of a network, so token holders, to participate and help secure the network. It's a little bit of a misused term in the crypto industry, because staking is being used for all kinds of different products which promise some kind of return to investors for locking up their assets. But the way we define it is that you actually lock up your stake to be able to participate in the consensus algorithm of a blockchain, which is actually what is securing the blockchain. And as blockchains grow and more value is being created on those blockchains, also the security needs to be upgraded. And that's why actually blockchains need token holders or shareholders to participate in this security of in helping provide security for the chain, which is something very new. So you can actually help grow a network, and because you are using your assets to help grow the network and help secure the network, you are actually getting rewarded for that, which is quite interesting. And Bitcoin was one of the very first chains that still uses mining, and therefore it uses mainly like electricity to secure the network. But all the newer blockchains that we see today, and even Ethereum, who recently moved to proof of stake, has actually now shifted over to look for capital actually to start securing the chain. And that makes it very interesting for crypto investors who are holding some of these tokens to start to participate in the security of the network and actually get rewarded for that. Obviously, there is a trade-off, because your assets are, as the word suggests, at stake, which is also something that is not always as clearly explained by kind of some of the providers who offer staking services. But yes, you could lose some of your assets, or you might get penalized for doing certain things. So it's important to understand that as well. There is a trade-off. You also have a little bit of lockup period sometimes, depending on the network you are. So it is a conscious decision that investors need to make. But it kind of enables you to look at tokens as a kind of an internet bond that gives you some rewards for helping the network grow and help provide security to the network.
Thank you so much. I think that's quite a comprehensive overview and a bit of a refresh for the audience. And Eva, like, I would love to hear from you with your Figment head, that how digital or how a staking strategy fits into a digital asset strategy, an institution strategy.
Yeah, of course. As Kasper said, what we're talking about here is non-custodial protocol staking, which shouldn't be confused with kind of DeFi, lending, pooled staking, or other kind of things that get lumped into the staking category. But in terms of non-custodial protocol staking that we support of Figment, we've seen two categories of institutions get involved. Firstly, the asset holders, so those with proof of stake tokens on their balance sheet who are looking to stake. And then the other side, we've seen involvement from counterparties offering digital asset solutions to their counterparties who want to provide this as an additional service. So it's both the asset holders themselves and those providing these services. In both instances, they're looking at staking to earn a return on existing assets. And generally, these are clients who have a long-term strategy in relation to digital assets. So maybe they're not so short-term trading, they're more long-term holders. And they want to stake as part of a treasury management function to secure the blockchain whilst earning returns, whilst continuing to hold their own keys. So there's no transfer of title in non-custodial protocol staking. and less counterparty risks because of that. So we see institutions considering staking as another feather in their cap for diversifying risk, continuing to hold the assets themselves, and to invest in a long-term future of proof of stake tokens.
Thank you so much, Eva. I'm wondering, Kasper, if from the point of crypto finance, is there something to add here?
Yeah, what I could say is that as crypto adoption kind of continues and more investors are starting to add crypto as part of their portfolio, I think we will see kind of more and more interest from investors to also start, getting into staking. And a lot of the providers that we work with, like financial institutions, they started with a fund which is holding certain assets, but it's not necessarily staking them. Or we have banks that have a retail offering towards their clients, or a wealth management offering where they offer spot trading and custody. And staking, I see it as one of the kind of the services that will become very relevant very soon for a lot of these providers who have a first offering out there and now want to add more value-added services to also give kind of some return to investors, because investors will start to demand some return, or they will want to put their assets to work in some regard, like we do in with traditional assets as well. You want to look for opportunities to grow your crypto assets, and staking is a very good entryway into that, to do it in a relatively risk-controlled manner, and also by contributing to the growth of these networks, which is essentially why we are investing into this asset class in the first place.
Super, thanks so much. Then let's navigate now to Justin, to Bullish. Bullish has been around for a while now, and you guys also are a member of the CVA for a while. We are really proud and happy to have you as part of our pool of members. Which are the ways Bullish helps its clients to unlock the value of their crypto, Justin?
Okay. Yeah, no, glad to be a member. So I think regarding unlocking the value of crypto, Bullish was really set up to be a partner of choice for institutions. So institutions do face certain challenges trying to access DeFi and DeFi sort of value opportunities. We're trying to provide that in a way that makes sense for institutions. So we can solve some of the legal and compliance concerns. All our counterparties, we're a centralized exchange, so all our counterparties have gone through strict KYC, all the coins have done the KYT, assets are fully backed or audited by Deloitte. That kind of thing adds, hopefully gives a lot of comfort to institutions. So I think regarding the value of crypto, there are really kind of two institutional customers that we could consider. There's the active traders and then more passive kind of long-term investors. For an active trader, what Bullish can offer is a very low cost of execution. We have deep liquidity. It's unique because of the AMM instructions that we use to provide liquidity. You won't find our liquidity on another exchange via an AMM, via a traditional market maker. So you see very good slippage, very low slippage. Our fees are low, so 0 maker, 1 taker, and in fact, even you get 0 taker fees for trading between stable coins. Yeah, so really, this sort of best X is the attraction for an active trader, and your single order book has all the liquidity, unlike in a more DeFi where you maybe have to look at multiple different spreads to access that AMM liquidity. Then for a more passive long-term strategic trader, yeah, you mentioned at the beginning the staking, lending, and market making. Lending is opportunity costs. We are going to bring lending to the platform later this year. Staking, we're actually waiting for institutional demand, but we're actively watching that space. But really, Bullish offers right now is the revenue opportunities from automated market making. So there we've taken the ideas that you've seen popularized by DeFi, including Bancor and others, Uniswap, but rebuilt them inside our exchange. We're not accessing liquidity on those contracts or on those platforms. all the liquidity is inside the exchange. And that removes a lot of the concerns that institutions might have regarding who they're interacting with and what the rug pull kind of various kind of potentially concerning situations they might have with a traditional DeFi experience.
Thank you so much, Justin. I will take questions from the audience after my question to Mark, which is the following. By the way, if you guys haven't realized, Carbon, the newest product of Bancor, has the same letters as Bancor, it's just different order. So Mark, tell us about what's Carbon's USP and what sets Carbon aside from, for instance, the uniswap V3 type of strategy.
Certainly. So yeah, Carbon is a fairly profound step away from what Bancor used to do. So I'd say traditionally, Bancor has been there to support new token projects, and this was our original mission statement. And remember that it is now quite old, right? This is dating back to 2017, when getting initial token liquidity on chain was somewhat of a challenge. But I think that DeFi has come a very long way since then, and we are now sort of building products that are catering more to the selfishly motivated, if I can put it that way. I still see the legacy Bancor products as being something that was built to provide a bit of a backbone for the industry to get behind. And I think that it did in many ways accomplish that task. And so now we're kind of turning our attention to more competitive products where people are choosing to take very specific positions on market movements and have the agency to see those plans through to fruition. So Carbon is much less of an AMM, and it's much closer to something like eBay. So the thing that it distinguishes it, I think, from things like Uniswap V3 and other competitors is that the positions inside Carbon first are asymmetric. So you're no longer forced into what is generally referred to as a short gamma strategy, which is the way that AMMs rebalance themselves and the specific financial instrument that's implicit in that kind of behavior. Carbon is much closer to being something like a grid trader, which is a trading strategy that has been used in Forex for decades and has just recently sort of risen to prominence in crypto trading as well, but exclusively in a centralized context. And what we've built is a much more general realization of that kind of trading strategy at a smart contract level, so that these things can be executed, permissionlessly. But another thing that distinguishes Carbon from other AMMs, and I don't consider Carbon to be an AMM, is that because the user's liquidity is discrete and it's not pooled in any sense, you have a much better view of the regulatory landscape while using it. So for example, Carbon's positions can be individually permissioned if you want them to. The user can elect which addresses they will allow to transact with them, and they can also choose to observe certain address blacklists or whitelists or whatever they like. And with emerging KYC products, such as from KYC DAO and others, if you wanted to use existing KYC infrastructure or emerging KYC infrastructure to choose who you trade with, then that will be allowed as well. So Carbon really isn't an AMM. It offers a completely different financial instrument compared to the status quo. And you are no longer in that uncomfortable territory of having to blanket oblige any trader or any liquidity provider who might want to exist alongside you or transact with you, which is very helpful given the emerging regulatory landscape. With respect to institutional use, Carbon was actually developed or inspired by conversations that we've been having with market makers for years now. Because they have been very reluctant, I think, to use DeFi resources directly. We saw a little bit of experimentation when Uniswap V3 was released, but it kind of tapered out a little bit. And after interviewing them, it was things like gas costs and other concerns that was really limiting the way that they interact with blockchain resources. And so Carbon is designed to be extremely gas efficient when it comes to managing your positions. So for example, in competing products, if you want to change the way that your liquidity is distributed or the price action that you're exposed to, you're forced to like withdraw all of your liquidity from the protocol and recontribute it to a different range. Whereas on Carbon, it's a very simple matter of just updating a single value or a collection of values on the NFT that represents your position. And this is, I think, a much more efficient way for professionals to interact with on-chain trading resources as makers, not necessarily as takers. And so, yeah, we are targeting that sort of professional audience, although I expect, you know, adoption will be relatively drawn out as these things are. As well with the institutional side of things, Carbon has no internal or external price oracles. And so when you want to contribute your liquidity, you can do it literally at any price. There is no prescribed price point that you have to obey when you are interacting with the protocol. And this means that token funds that have accumulated very large collections of certain tokens, especially through rewards programs or early seed investing and things like that, often find it difficult to scale out of those positions, you know, through TWAP or other processes. Whereas with Carbon, you can literally just set your asking price, and sometimes that might be below the market rate. And you can rely on searcher networks and arbitrageurs who have access to literally every centralized exchange and every DEX to pressure the market for you. So we're finding a lot of really interesting use cases with the infrastructure that we've developed. And I'm very much looking forward to developing our relationships with institutions now that we've launched just an hour ago.
Congrats. Cheers.
Thank you.
Yeah, I would have asked a follow-up question, Mark, that since when is Carbon live? But yeah, today is the time, today is the date. Super. Then I would love to answer the question of Thomas from the chat, which is the following. What should a token holder look at when choosing validators? Eva, I feel like this is a perfect question for you.
Yeah, sure. Happy to take it. I think from my perspective, I always look at this as who to look for in a staking partner rather than just a validator. There is so much more that encompasses staking than just provisioning validators provisioning nodes. And it's about a partner that can provide you with the level of security that you expect. Figment, we prioritize safety, security over liveness. So what does that mean? That means that we focus on avoiding slashing risks rather than just promising and promoting uptime. So the validators staying online. So say that would be a key thing to look at. What is the staking company's track record in terms of slashing? What are their security methodologies? How do they manage that internally? What are the expertise of the team? How do they understand the governance for a particular protocol and the updates of networks? How is that managed from a DevOps perspective? So I think those are very key areas to look at. And then just in general, their performance, how have they performed as both their validators and from a security perspective, and then look at the expertise of the team outside of that. So regulation, tax, compliance, coverage. Do they have people that understand those factors of staking and provide you with support in those areas too?
Thank you so much. I think this is a very
maybe if I can add one point, Emi, I think most of us are aware what happened with one of the larger platforms in the US who actually had to unstake all the assets of their customers. So that's also quite an important point to look at, is like, have they got the right setup? Is it really staking? Have they got regulatory approval, or did they at least talk to a regulator to make sure that they have an offering which is trusted and that is also a bit built to last? Because the last thing you want is that you're forced to kind of exit all your validators or all your stake and move it somewhere else and lose rewards in the meantime. or even worse, like a platform could go down if it's a non-custodial setup and the assets are not segregated, or it's not clear who owns the assets after you stake them. Those are also very important factors to keep in mind when you're looking to stake your assets.
Totally agree. And I think the importance there is also, as you said, Kasper, a long-term partner that's thought of this staking strategy for the future and how things might evolve and how they're positioned for any changes from a regulatory perspective or otherwise.
Thanks so much. As next, I will take the question of Paper Street Capital. And they ask, what do you believe is the primary hesitancy for further institutional adoption into the crypto space? So I understand that which are the main adoption breaks for institutions? Who wants to take this?
Yeah, I can take it. Oh, go ahead, Justin.
Justin, in this order.
Okay. Well, I mean, from our side, I think regulatory clarity would be tremendously helpful. I think people have concerns about what seems to be changing views of what were previously accepted. Whether it's SEC or whether it's whatever regulator is involved, the views seem to change. It is not clear to people how it will be treated both now and in the future. So those kinds of things do cause people to worry, to have concerns. Regulated out of Gibraltar, we don't have that issue, but nonetheless, I do see that being a bit of a restrictive thing. Sorry, Mark, do you want to?
Maybe to add, like Mika just passed the European Parliament vote today, which will be quite a big thing for Europe, I think, to bring regulatory clarity. It will still obviously take some time to come into effect, but at least in Europe, we're seeing steps in the good direction. I think in Switzerland, we're already pretty good. But yeah, the US is definitely still quite difficult for some providers.
Yeah,
I think that
today, Carbon launch, Mika, Mark, over to you.
Yeah, I think that there's always been this discussion about regulation. And I think in the years leading up to right now, especially with respect to the United States, it has been about a lack of clarity. I would say that right now we actually have pretty good clarity, and it's an extremely hostile regulatory environment, one that doesn't reward people for compliance, but rather chooses to rule by enforcement. And I think that there is it's a backwards scheme. With that in mind, I think that certainly has been the single greatest deterrent for mass institutional adoption. But having said that, there are still, it doesn't affect every institution the same way. And from the institutions that I've spoken with, they don't even all have the same, not necessarily, I don't want to say, interpretation of the law, but it seems that not all laws apply to every institution the same way. And they don't all necessarily have to observe the same regulations. And so, to say that there hasn't been institutional adoption, I think is kind of missing the point. I think that there is pretty good institutional adoption. It can be a lot better, but it's not like it's zero. But I think, in terms of opening the floodgates and crypto being as welcoming as it could be, certainly the hostility that we're seeing in the United States is a pretty big deterrent and can't be ignored.
Thank you for adding here more caveat to answer this question fully. I would love to take Jerome's question, but in the meantime, also want to highlight for full disclosure that I have the honor of being on Bancor's council, and I forgot to tell this at the beginning at the intro. So being super neutral here. However, all participants have equal airtime. That's one of the golden rules of a good panel, I find. And Jerome's question is, what kind of added value do you add for staking as an institutional? Eva, I feel like you're the best. You can answer the best. You're the best, but also you're the best who can answer this question.
So the key benefit is obviously the returns generated on staking. So the returns determined by the protocol that are passed through to the asset owner after they stake their proof of stake tokens. This is used as I mentioned before, often as a way to manage treasury for assets that would have otherwise sat on the balance sheet, essentially not doing much. It's a way to utilize those assets. It's also a way to prove ownership. And it's another benefit is to think about it as a proof of ownership of the assets. If you didn't own 32 ETH, you wouldn't be able to stake it. So while it's not exactly proof of reserves, it can be used to demonstrate proof of ownership, in that if you didn't have those tokens, you couldn't stake them. And I think the benefit, as well as just the involvement in the ecosystem. So continuing to secure the blockchain, participate in governance, be an active member of that particular network, and encourage the the progression and the success of that network by staking those tokens.
Thanks so much.
I can maybe add a little bit because I'm also a home staker. So I do some self-staking and I can compare the two. And definitely you can stake yourself, which is one of the great things about Web3. You can be your own staker, you can run your own hardware, but it does require quite a lot of attention and a lot of DevOps. You need to have some experience. You need to monitor it. You need to make sure it's up. And I would say what an institution can bring is like peace of mind. It's managed properly. It's up. You get the highest potential rewards from it. They will follow all the chain upgrades, etc., etc. And to me, that's worth quite a bit. I mean, there are obviously enthusiasts like myself who like to tinker around, but if I would have like a large pool of assets, I definitely would be a bit scared to do it myself, because there are also some risks involved if you make some mistakes yourself, where you can lose a significant amount of your assets. And it's also a bit the same like with self-custody. You can be your own custodian, which is great, but then the counterparty risk is against yourself. If you lose your keys, or if you don't store them in a proper way and you lose your assets, it's your fault. So that's not good for everyone. And definitely if you have a large amount of assets, you might want to look at something which is a bit more professionally managed. And I think that's where like institutional setups are quite useful, to bring peace of mind, to give you a high return, and also to be able to manage larger pools of assets without having to do a lot of research yourself. And if you have assets, if you have a diversified portfolio where you stake a number of different currencies, you need to understand a little bit the differences between all the chains, and they can be quite profound. Like Ethereum is a very different beast than Polygon or than Solana, and in Ethereum the risks are quite complicated. There are a lot of different risks that you need to understand, and a staking provider or an institution obviously studies those risks and makes them transparent to you and also manages them. And I think that's worth quite a bit.
Kasper, I love that you highlighted that Ethereum staking is much more complex. Also, just the machinery you need, it's so much more powerful versus running a Raspberry Pi for Bitcoin. So we still have a lot of staking questions coming in. We can take them for a bit later, but let's go on with Eva, and maybe Eva, you, if you like, you could answer this one. Is validation a commodity service? But before that, let's talk about the big happening in Ethereum's history last week, the Chapala upgrade. This is a massive milestone. And what has changed after Shanghai? Maybe you can unpack a bit what Chapala and Shanghai meant, and are more counterparties looking to stake as part of their treasury management?
Yeah. So maybe just start off by talking about what Shanghai, what on earth Shanghai and Capella or Chapala are, and why should people care. So the Chapala upgrade was a withdrawal functionality addition to the Ethereum network that occurred last week. So it allows for both full and partial withdrawals. Essentially, maybe this oversimplification is to describe it as a system upgrade that allows for Ethereum to be unstaked and withdrawn like a a cash out ability being switched on the network. Now, of course, that is a huge simplification. And if my head of Ethereum research were here, he would probably be throwing things at me saying that it's not quite that simple, but maybe that's the best way to think of it for today's webinar. And it's another piece in the puzzle following the transition on the network from proof of work to proof of stake. It's been important for customers who need liquidity. So if an asset manager or a hedge fund had a certain mandate in terms of access to tokens and liquidity in tokens, not locking up funds for a long duration, they might have been prohibited from staking their ETH prior to their withdrawal functionality being enabled, because their shareholders, stakeholders didn't like the fact that they wouldn't have access to these tokens, as they would be staked, bonded to the network. So it opens up ETH staking to a whole new group of institutional participants. It makes it easier to build more products around Ethereum. We're seeing interest in structured products, ETPs around staked ETH. So it increases the access there to staking Ethereum for lots of different and new participants. And I think just the success so far of the upgrade continues to build confidence in the network. And although we're seeing withdrawals, I think overall we're seeing lots of people come to stake their Ethereum and increase both, from a liquid staking perspective and in a general non-custodial staking perspective. We're seeing both types of participants come into the staking marketplace now. I don't know, Kasper, if you've seen, had a lot of phone calls since last week about ETH staking, asking you about it now that it's been enabled, withdrawals have been enabled.
Yeah, definitely. I think interest picks up, and we didn't offer it previously because you cannot effectively, you couldn't terminate a relationship with a business counterpart because you couldn't get your assets out, and the party who you staked with essentially would always have a copy of your validator keys because you couldn't exit the validator. So that's something which changed now, and I think that will also encourage more investors to look at it. But also on the flip side, I think you will have more companies now who are going to offer ETH staking, and that will hopefully also decentralize a little bit the different staking parties in the ecosystem, so that we have less stake with one big party, and the stake will be a bit more spread out, which is good for decentralization of the network. So I'm hopeful that now that this is available, that indeed will alleviate some of the concerns that some of the hawks had towards proof of stake, where a lot of the assets were being pooled, for instance, with some of the larger, like for instance, Coinbase has quite a big a share, or Lido, and hopefully we see that go down a little bit and get more spread out also between other staking providers to promote a bit decentralization of the consensus mechanism.
Thank you for answering the question. Let's chat also about other ways to unlock your the value of your digital assets than staking, and then we can circle back to staking. Justin, I'm curious, this Kasper now, which of the Bullish services are the most profitable? What is their main revenue driver?
Sure. Okay, so profitable for who? For us or for our customers? Both, hopefully quite aligned. For traders, Bullish is a great venue. We've done some studies to sort of compare ourselves to Coinbase or Binance. If you include reasonable assumptions for taker fees and the liquidity you're demanding, if clip sizes are up to sort of $30K, $50K, Bullish on average beats Binance and Coinbase for Bitcoin and Ethereum slippage when trading. And of course, there are other benefits of using centralized system. I've mentioned the gas costs you get with DeFi. Yeah, it's a nice place to trade if you're a relatively high frequency trader. But for Bullish and for our more longer term investors, the automated market making is the primary revenue stream. The model we have is quite unique, certainly within centralized exchanges. So we've tried to align as much as possible our interests as a platform, but also our customers' interests. So we take a share in the overall profitability of using AMM instructions. That's how we make most of our revenue. So those are built from the spreads contained, the spreads chosen by the customers for their AMM instructions and the taker fees that they get paid when they provide liquidity. So that the taker fees, to be clear, go to the AMM instruction providers, not to the platform, other than through the percentage share. And this seems to be working. As I said, we've traded $200 billion as of this week, I think the expectation is. So both customers on supply and demand seem to be pretty happy with that arrangement. I think in terms of profitability moving forward, or even just now, our goal with Bullish was to take some of the best ideas of the DeFi that have been. It's a constant improvement. Mark's got a great one today. Very interesting kind of range orders and things like that. So there's constant improvement, constant enhancements. Our MM is not just a Uniswap clone. It's you don't have to route between different fee pools and single combined order book, and we have dynamic spread features that, if used correctly, can dramatically impact your the profitability of an automated market making strategy. So, yeah, back to the original question. AMM instructions are definitely the primary revenue stream for the platform and for many of our customers.
I find it super that you enable in a centralized environment a decentralized product in a way. And I was curious if crypto finance, like what's the main revenue driver? Tell us, Kasper.
Sure, Emi. No, I also want to echo that it's quite interesting to have an AMM as a centralized setup to kind of make use of the technology, but also if you're a regulated party, it's still quite difficult to get into true DeFi because you don't know who's on the other side. So this is a bit of a best of both for regulated institutions. From our side, obviously, I think the whole market has been through quite a difficult period, but we have seen that some of our clients moved assets away from kind of unregulated platforms into our custody. So we've seen an uptick in custody assets because clients are looking for regulated custodians who fully segregate assets and are supervised. I think we've seen that across the entire industry, also with some of our competitors. Most of our income still comes from brokerage, but also here we've seen an uptick in interest where a lot of the banks or other institutions who already have a trading setup now come to us because they want to have a regulated counterparty for trading. So, and there's not that many providers in the market today. I think that will probably change over time, but that's really where we have a good selling proposition today and where we see quite a lot of demand, and brokerage is still one of the biggest revenue drivers for us. Then we discussed it before already, staking and some of the other added value services are still in early stage, but we're continuously working to develop them to also offer, like later when clients are ready for them, to have also quite a good offering there, which is built with the same regulatory standards, institutional standards as the custodian and the broker.
Super. Thanks so much for answering my curious questions. Then I would love to go on with the next one dedicated to Mark, and that's about Carbon's multi-chain capability. You think that Carbon will be a multi-chain product? Is there a realistic expectation to have Carbon deployed on other chains than Ethereum mainnet?
Yes, absolutely. So historically, we've been I think skeptical about like moving to other blockchains because of the systemic risk that was inherent in the way that our previous protocols were designed. I should point out though that Bancor had a cross-chain deployment with the launch of EOS, and so we've kind of been in that situation before, and I think that in a way that made us even more skeptical of the developing layer 2 and alternative layer 1 stuff that was that was developing around DeFi summer and since then. In many ways, I think Carbon is in fact better suited to some of these faster, cheaper chains. There are features that I have envisioned for Carbon that I think are you might even say contingent on faster, cheaper transactions. And again, speaking to the institutional side of things, I alluded to the fact that we have designed this with institutional use cases in mind. And a lot of the market makers, for example, that we speak to are used to, managing their liquidity positions on microsecond timescales on centralized exchanges. And we certainly can't offer them that on Ethereum. The 12-second block time is an eternity for them. But on like directed acyclic graphs like Phantom and Hedera, that kind of finality is there, so that we expect that kind of use case to be at least a little bit more attractive. And then on Ethereum's scaling solutions such as Optimism, Arbitrum, Polygon, and so on, I do think that it will be even more attractive there. Arbitrum has got a very significant DeFi following already. I think GMX has kind of laid the ground for let's say, it has cultivated a very active community of traders there. And so I'm very interested to put Carbon in the hands of the people that are already there. So yes, absolutely. It's where I was once reluctant, I am now extrememly liberal about where I think Carbon should go. So if there's any blockchain with DeFi activity, be it an EVM chain or a non-EVM chain, right? We're agnostic to programming languages. I fully expect that we will see Carbon deployed there, if not immediately, then eventually.
Super. I didn't know you were reluctant when it comes to being multi-chain, or this aspect. Interesting. Cool. Then I have two more questions to all of you, and then we can circle back to the audience questions. So we always tend to say that bear markets are for building, and bear markets are where you can really build long-lasting partnerships. And when you are partnering with another service provider, an exchange, or on-chain protocol, anyone you partner with, what do you best, or how do you best decide who to partner with? A long question. Eva, you want to go first and give a bit of a viewpoint?
Of course, yeah. So I think you're always judged by the company you keep, right? So you want to partner with the firms who have the same ethos as you, so focus on integrity, security, compliant market structure. So I think that is at the forefront, at least of Figment's mind, whenever we're looking at partnerships, partnering with firms that are building on the same foundations that we are. We have security at the heart of everything we do, and we look for that in our partners as well. Who is working to improve the ecosystem? Who is working to secure the ecosystem and generally better the crypto markets? So I think that's, although it's quite general, that is kind of what it comes down to begin with. And then expertise. We're looking to work with the best people in the industry. We hope to employ the best people in the industry, and we hope to partner with them. Expertise matters. So from our perspective, we can't be all things to all people, and we don't try to be. We specialize in staking. That's our bread and butter. That's our focus. And we bring in the best people from the protocol team, research team, sales engineers, DevOps, across the board. But we focus on staking. So in partners, we want to partner with exchanges, custodians, trading platforms that are the experts in their field. We're not trying to become all of those things. We're sticking to staking, but we're looking for the leaders in our partners in those respective fields.
Thank you so much. Justin, do you have anything to add? Bullish point of view, or your personal point of view?
I mean, head of trading product, I'm not really business development or that kind of thing, but I think as a firm we are obviously very keen to find high quality partners to help us with our goals and help us move forward. We do look for help for various parts of the system we've built. For instance, we work with Bancor as a custodian that ensures we can have certain guarantees for our clients when they're, in terms of what would happen in the case of a bankruptcy or something like that. So those kinds of things are always in forefront of our mind. Our CEO, Tom Farley, is ex-NICE. He's obviously very he's steeped in this kind of space in the sense of what institutions need and understanding sort of table stakes for how to make institutions comfortable, and also in terms of looking across the space to see who might be a potential future partner for anything we're looking at in the future.
Thank you so much for adding or sharing your viewpoint. Mark, I see you unmuted yourself already.
Yeah, so I think, a lot of the points that I've already raised, I don't have too much to add to. I think what I will say is that, as a DeFi project, sort of much closer to, I guess, the turbulence that you kind of, that the markets experience. And we're also exposed to a lot more of the, the variety, I suppose, of the different characters that, arrive on the scene and want to produce projects. And I found that during the bull market phase, it was a little bit less obvious who the good actors were, right? And it was, some people are very good at hiding their insincerity. But since then, I would say that the market shakeout has meant that the people that kind of remain and that are still, that we're still having conversations with regularly, generally are really committed to what they're doing. And these are the kinds of people that I like to partner with. After that, there's always the, the overnight layover test, right? If you had to imagine yourself trapped in an airport terminal with someone overnight, is it someone that you could speak to? Are they friendly? Do you like working with them? I think that it's almost the same way that you might approach an interview, right, for a new candidate. I prefer to work with people who are good, individuals and that are, that I can imagine myself sharing a beer with or something after work. But other than that, I think that all of the major talking points have already been mentioned by the other guests.
Thank you. I'm curious if Kasper has something else to add, and it's a good point that in this bear market sometimes there's quite some filtering happening, and we learn who are in this for the long run, who are really believing in the principles of crypto and blockchain tech. Kasper, what did we not mention here?
No, we also look at partners with a similar mindset. I think the recent history has taught us that going slow but do things properly is the way to go. That's the way how you remain relevant, how you build something that lasts, and how you can weather a storm. So when we look at partners, we also look at partners who will look a bit into the future. Some things the regulators are a bit behind. Maybe some things are not fully regulated yet, or there's a bit of activity where it's a bit unclear. But we try to kind of look for partners who have the right mindset, who do their due diligence, who engage with regulators also for things which are maybe not fully regulated yet. Like we engage with FINMA to get approval for our staking offering, for instance. So yeah, you want to have partners who have a similar mindset with you and who are also, willing to offer sacrifice maybe a bit of short-term return for long-term stability or gains, or having something which is a bit more longer lasting, and that will also make regulators comfortable.
Super, thank you. So we arrived to my last question, which is, what does it take that we have an uptick in the market? And if you could wish just for one thing for the next months, quarters to come, what would that be? And I will shake up the order now because we can go, Kasper, a quick response to this one. What does it take for adoption to accelerate? And we see more and more institutions coming.
Yeah, so I mean, I think from a tech perspective, we are definitely not in a bear market. Maybe from a revenue perspective, I mean, there's so many good things going on. We had the merge, we have NFTs on Bitcoin, we have rollups, we have breakthroughs in zero knowledge proofs. I think if I could wish for one thing, it's maybe the Chat GPT moment for blockchain. That would be great, where we get like 100 million users in one go. But yeah, I think from a tech perspective, we are steadily making good progress. There's more applications coming. And I think once trust comes back into the market, we have the right regulation, we have the right providers. I think the market is set up to grow. And then I really believe into the future of this whole ecosystem, because I think the foundations are there, and the principles of decentralization, community building, etc. I really believe in those, and I think that will bring adoption in any way. Like people want to have it, and so yeah, it's going through its growth phase, and we'll get there eventually.
Super, thanks so much, Mark.
I'm not really sure. I think there are so many things that I want to see happen, so I'll try and keep my answer short. But I would like to see, I think, a slightly different attitude from the United States with respect to its crypto regulations. I think that the rest of the world is setting a good precedent. We've seen, for example, I was just in Hong Kong, and it's there is sort of a almost, I heard it referred to as a type of Chinese virtual machine for different markets, and crypto is really taking off in a pretty big way there. I also heard about the Hong Kong centralized digital currency was supposed to be announced around about that time. I'm not sure if it's been announced since. Even with the MiCA proposal being accepted by European governments, and I think that these are all good precedents. However you feel about the MiCA proposal or not, it's still a step in the right direction. If I had to choose anything, I would like to see at least that kind of progressive thinking from the United States. And I think that a lot of the backlash we've seen against the hostility that I referred to earlier in recent days, I think is a very good sign that there are critical minds paying attention to what's happening there, and will not allow the United States to relinquish its title as innovation capital of the world. So if I had to choose anything, I think that would be the number one thing that would benefit us all in a very terrific way.
Super, thank you so much. Justin, I will let Eva go first. What do you think? And then last but not least.
Thanks, Emi. So what do I think it takes to see an uptick in the market? I've been thinking about this a lot recently, and I think maybe it's either much more stability or absolute instability in the traditional markets. We've seen the US government trying to cut off access to fiat rails for a lot of the crypto or the tech Web3 type banks. So cutting off those access to fiat rails has actually pushed people into crypto, and we've seen a slight uptick in the markets there. If they continue to do that, maybe that will be a pivotal moment for crypto. Or also if we see inflation stabilize, things calm down, will that be something that will restore confidence? And what do I wish for crypto? Maybe for it to become boring. Let me qualify that by saying,
no, we don't want that.
Let me explain. So I think that once crypto starts to fit into our everyday lives, and is something that it's just accepted and people don't question it, people will start making payments, transferring ownership via the blockchain without even realizing what they're doing. I think that will be really pivotal, in the same way that people send an email and that they don't figure out or think about how they're sending that email. It's just part of their everyday lives. I think that will be an important step when it's just ingrained in everyday life, even more so than it is now.
Thank you so much. And Justin, what is your take?
Very good points raised just now. I do think it being boring is an important part of our future. it will be when you don't have to put the word crypto because it's assumed, that's going to be an important time, like when you don't have to put the word mobile because everything's mobile now. So yeah, that's coming. It's not coming in the next few months though, so we have to wait a bit longer for that one. I think as Mark was talking about with the US regulators, and there's so much such a mixture globally of expectations and situations that it does cause difficulty for typical institutions who aren't steeped in this, who aren't doing this day to day, to understand what the current situation is, and it does frighten people away, I think. So I even mentioned the fiat rails. You know, we Bullish had to pivot pretty quickly to support, you know, adding properly supporting USDC and USDT. You can now convert quickly, but so yeah, it's been challenging. I think what I'd like to see is just a return to more stable situation that we had 6 months ago, and I think we'll get back to pretty soon with regulators. We're very happy with our regulators in Gibraltar, but other regulators who are willing to work with organizations to move forward responsibly and foster innovation, not prevent it.
Thank you so much. I invite everyone in the audience, but I will just do myself to thank you all, Eva, Justin, Mark, and Kasper. This has been super informative. I also encourage the people who asked questions to reach out on LinkedIn or Twitter to the panelists. They will be happy to respond. We didn't have time now for that, but we have in 6 months another session like this. We can meet again, and then we can see if your wishes came through or not. Thanks so much.
Cool.
Thank you, Emi.
Thank you, Emi.
Bye
Bye-bye.
for now.
Thanks a lot.